Hello, my name is Mark Douglas, and I'm the author of The Disciplined Trader and Trading in the Zone. I've been a trading coach since 1982, and over the years, I've worked with some of the industry's biggest hedge fund and money managers, as well as some of the exchange's largest floor traders. I know that all of you want to experience consistent results from your trading. In other words, you want to be able to generate an income you can rely on. However, one of the major obstacles in trying to accomplish this objective is in the area of trade execution. To produce a consistent income, a trader has to be able to execute their trades without making any errors or mistakes. In other words, trading without hesitation, reservation, or internal conflict. Basically, all of the errors we are susceptible to are a result of a lack of confidence, or more specifically, trading with fear. What most people don't realize is that trading without fear is actually a learned trading skill, a skill that has to be cultivated and is the primary difference that separates the professional from the typical trader. In this series of DVDs, I'm going to provide you with the kind of insight, understanding, and specific mental techniques you'll need to learn to trade without fear, so that, like the professional, you can move in and out of your trades with the kind of confidence and ease that will allow you to take full advantage of your wise trade or any other trading methodology. Hey, hello. Yeah, good morning. And also, too, how many people came from the West Coast or in the West Coast time zone? Yeah, it's like the wise trade people picked me up at 6:30 in the morning, which was 4:30 in the morning for me. So when I say that, when I say this, we're here for you, and to ignore the cameras, ignore the environment, I really mean that. But at the same time, I want you guys to help me a little bit, okay? It might take me a little bit, to get going, because I'm not used to doing presentations at 6:30 in the morning my time or 7 o'clock in the morning my time. But anyway, what we're going to do is we're going to go through the process of learning how to think like a professional trader. Why would we want to learn how to think like a professional? Anybody got any ideas? What's that?
Make some money.
Make some money. But you don't have to think like a professional to make money, do you? What does it even imply? What does it imply to think like a professional trader? I mean, let me ask you this. How many you guys have, I don't know what your trading experience has been in terms of the number of years you've been at it, or kind of give me an idea of the demographics here of the audience. I mean, how many people have been trading for more than 2 or 3 years? Most everybody? Then less than 2 years? Kind of new people? Oh, okay. So we've got about half and half. What would it mean to you guys to say, well, let's think like a professional trader?
You're not thinking like an amateur.
What's that? Not thinking like an amateur. Okay, that's good. But what are the implications of the difference between a professional and an amateur?
Right, consistency.
Consistency. There you go. You see, you're at my Houston workshop, right? Yeah, consistency. Exactly. In other words, what that would imply is that if I'm a professional trader, in other words, if I've aspired to be a professional, one of the implications would be that I can make consistent money, because if I'm trading in the mode of a professional, I could be a hedge fund manager, a professional hedger working for trading companies, or just having a full-time job as a trader where my income, my sole income, is derived as a trader. And to be in that kind of a position, or to be in a position where other people are going to give you their money or give you their assets to be able to, make money for them, it would certainly imply that you can make consistent money. That there's a way for you to, let's say, create an equity curve that looks, something like this. Isn't that right? Are you going to give your money to somebody with an equity curve that looks like that? I'm not saying that people don't do it, and I'm not saying that it doesn't happen. But I'm saying that if I've aspired to be a professional trader, It means that I must have learned something that's different than the people who can't do this. There must be something about the way that I approach trading that allows me to do that. And believe me, there is. There's a lot. What's that?
Cool.
Yeah, cool. Basically, and I don't know how many people in the room have either read Trading in the Zone or The Disciplined Trader? We've got a few people. So probably there's actually most of the people in the group aren't familiar, maybe even with me or my background at all. True or not? Yes or no? See, no, right? Oh, okay. So I'm going to just give you a little bit, and I'll give you more later on. But I started trading back in 1978, and the first trade that I made, the first trade I made was in potato futures at the Chicago Mercantile Exchange, which they don't even trade potato futures anymore. Why I picked potato futures, I have no idea. I think that's probably what my broker said I should be trading. Maybe he said that there was an opportunity in potato futures, but anyway, I made money. And of course, just like most people who make money, their first trade or their second trade, it's about as easy as one could imagine, and therefore you think to yourself, oh my God, why didn't I learn about this a long time ago? That sounds kind of familiar, right? In terms of a thought process. And I went from trading potatoes to trading gold to trading silver. And I'd say my trading experience back then was probably typical even to what it is today with most people, although you have to keep in mind that the technology that we had back then wasn't anything like what you have available to you right now today. It still boggles my mind when I think about the way we had to trade 25 years ago, or almost 30 years ago, compared to what's available right now. I mean, I've always been attracted more to trading commodities than stocks. As a matter of fact, I've never even traded stocks. I've always traded commodities and options. And I've never really had the desire to trade on the floor of the exchange. Although I lived in Chicago for 20 years, it never really appealed to me. I don't know how many people are familiar with the floor or the trading pits, but I just thought it was an extremely harsh environment, and not something that just, like I said, it appealed to me. But the kind of trading platforms that you guys have available to you today really, truly approximate what it would be like to have a seat at the Chicago Board of Trade or Chicago Mercantile Exchange and to trade at that level. You have instantaneous execution. And it's like you can change your mind and not feel humiliated or like there's something wrong with you. You can put it in order. You can cancel it. Back before the advent of electronic trading platforms, we used to have to call a broker. Now you think about the time you made a decision to put on a trade. You think about the time that it takes one to dial the phone, for someone to pick the phone up. How many times it has to ring, and then he gets on the other end of the line. You got your broker, and then you give your broker your order, and then you've got to deal with the fact that does your broker really approve of your order? In other words, what I mean by approve is that, well, see, I want to buy 3 gold contracts. I say, well, some of my biggest customers, they just went short gold. Now what are you going to do with that information, okay? Or I've got, X number of guys that are on the other side of that trade. I say, well, yeah, if you want to take the other side of their trade, I mean, that's fine with me. I'll put the order in. So it's like, so he could put the order in, and then, you've got to wait for a fill. I can't tell you how many times that I put orders in the market where they were limit orders because they didn't want to do a market order because I didn't want to get the slippage of a market order. So you do a limit order, and on a limit order, the market has to trade. To be guaranteed to fill, the market has to trade through your price, does it not? How many times has the market traded to your price, okay, just right to your price on a buy order and reversed, and you didn't get filled? That's very possible. The problem when you're doing it with a broker over the phone is that order goes into the pit. It goes to an executing broker in the pit itself. So you've got a runner, and the order got to go back to the runner, back to the phone bank, back to the broker, and the broker calls you with a fill. You're talking several minutes. Now, what if you're in a situation in a fast market where the market actually hit your price? You may have gotten filled, but you really don't know. You don't want to put a stop in the market because you don't even know if you're in or not. And the market's screaming, let's say, even in your favor, and you'd like to take profits, but you still haven't gotten your fill back yet. You don't even know if you're in the market. This is the kind of stuff we had to deal with all the time. All the time. It was a completely different world. Not only that, the only information that we had available to us was open, high, low, and close. That was it. Open, high, low, and close bars. And we used to have to get those unless we talked to our broker and pestered them, X number of times a day. You get it through the Wall Street Journal. We used to have to keep our own daily charts. Intraday stuff was just like non-existent. So anyway, I started trading like that. I went through, I don't even remember what my first trading account was. I think it was around $20,000. I lost all of that, and then, I saved up some money and opened up another one for around 15, lost all of that, and then went to another broker, and I'm thinking this guy doesn't know what he's doing, and I'll find somebody who does. And then this is what really, this is probably the reason I'm even standing here today, was this particular trade, because this particular trade, it had a profound impact on me in terms of how it changed my life and what I was willing to do to find out what this was all about. To find out really what does it take to be a consistently successful trader? What does it take to really be able to earn an income as a trader? I was long silver. This would have been back in right around 1980 or 1981, or 1980, I think. I was long silver at around $9.75 an ounce, and there was two 5,000 ounce contracts at the COMEX. In other words, I was long 10,000 ounces of silver at $9.75 an ounce. And right after I got into the market dropped about 20 cents on me to about $9.55. So I was down $2,000. And my broker said, well, okay, here's what we're going to do. Instead of getting out, we'll put you into a spread. And so what we'll do is you're long 10,000 ounces of silver in New York. We'll go short 10,000 ounces of silver in Chicago, because you could trade Chicago silver at the Chicago Board of Trade. Everybody with me on this? Just want to make sure that you guys are all with, even though I know many of you are stock traders, the concept is the same, okay? So I'm long 10,000 at 975. He puts me short 10,000 at 955 in Chicago. So I've got this spread going on. And then he said, well, when the market goes back in your favor, we'll just take the short leg of the spread off. Now, keep in mind, back then, you guys are. What do you typically pay for commissions, even in commodities, or even I don't know what you'd pay for stocks, but typically the average commission is about $4 to $5 a round turn, right? That's what you'd expect to pay. No, what are you paying? Less?
No, more.
More? Round turn? Wow, really?
I got the lowest.
Well, you're in the Dow. You're in the Dow Mini. What are you paying for the Dow Mini?
11.
11.
Oh, that's as low as it started at like 30.
Oh, okay. Well, anyway, then 11.
89 back in the day.
Oh, okay. Well, back then, back in the 80s, how much do you think we were paying back then? Come on, give me a guess. Come on. Get. What? Yeah, 125. How's 125 a round turn? Yeah. Per contract? Yeah. So in other words, for me to put this trade on cost me $250. Yeah. Okay? When he put this one on right here, it cost me another $250. And then he said, of course, that when the market goes back into my favor, he'll take the short leg of the spread off, and I should be all right. So that's exactly what the market did. The market went back up to right around the 975 area. He took the short leg of the spread off, and then the market immediately dropped back down another 20 cents and put the short leg of the spread back on again. So that's another $250, okay? Plus, he just locked in. When he took this off, First of all, he locked in a $2,000 loss by putting this trade on. When the market went back up to 975 and he took this off, he locked in another $2,000 loss. And then when it went back down again, he put it back on and locked in another $2,000 loss. Now I'm down $6,750. Okay? And then, of course, it happened 2 or 3 more times. Now, from the market's perspective, all the markets, the silver market's just in a trading range. That's all it is. It's just in a trading range. But I didn't know how to read chart patterns at the time and didn't really understand what was going on. I was just listening to him. And so what he was doing was just taking advantage of the fact that it was going back and forth between support and resistance and generating commissions for himself, okay? That was it. That's basically, he was just turning my account. But that's not the story, okay? That's happened to a lot of people. Of course, it happens less now because we're all responsible for the trades that we put on. All we have to do is click the mouse button, and it's not that much money. But here's the story: is that as these losses are mounting, okay, and I can't sleep and getting real stressed out. You know, I wake up one morning and I thought, you know what, this is it. I just can't take this anymore. I just can't take it. And so, you know, when I got to work, I called them and I said, you know what, just get out of the whole damn thing. I just can't do this. So just liquidate the position. Does anybody remember the Hunt Brothers silver debacle? Oh, it didn't. Does anybody, if I say the word limit up, does anybody understand what I mean by that? Okay, the exchanges will impose artificial price limits of how much a commodity, or even a stock for that matter, can fluctuate in any given day before they stop trading. So we don't have these kinds of moves too much anymore. But back in the 80s, limit moves were really quite common. They really were. In other words, what would happen is this: is that if the market went up, let's say, I think in silver it was 50 cents. I don't remember exactly what it was, but if the market went up by 50 cents, they would actually stop trading. Meaning, if the market was bid up to, let's say, in this case, $10.25, trading would stop. In essence, what this means is that at 10.25. There were no people, there wasn't anybody in the world, this is important for later on. There wasn't one person in the world who was willing to sell silver at 10.25 if it was a limit move. Not one person. And so what happens is that the price will go up seeking to find who will actually sell. So what the exchanges didn't want is there to be this huge fluctuation all in one day. There might have been sellers at 10.26, or there might have been sellers at $11, but you don't know that because the exchange says we're going to stop trading at 10.25. You guys with me on this? Okay? So what happened is that I don't think it happened more than maybe half an hour, 45 minutes after I got out. The market was trading right around $9.75 an ounce, where silver went limit up. And went limit up, was 30 days in a row to $49 an ounce. To $49 an ounce. I was looking now think about this, okay? Now think about being in this kind of a winning trade. Now, when we're in a winning trade, the market almost never goes straight up and it never goes straight down. There are rare occasions, of course, like in this case, when it does. So that when we're in a winning trade, we have to constantly be making decisions about where we're going to take profits and how much heat we can take with the market coming back against our position to say, well, is this a time to take profits? Or am I going to let it come back a little bit further? Am I going to come back a little bit further against me? Because, well, is this normal retracement or is this more significant, okay? Is this a little bit of a profit-taking retracement? Is it more significant? Should I get out now? Do we have more left? Are we going to make new highs? You got to be making all these kinds of decisions. And it's very difficult, as we all know, right? See, in this case, I didn't have to be making any decisions because the market went limit up 30 days in a row. Boom, boom. It was like, go ahead.
Were you out or were you still?
I was out. I just got out like a half an hour before it happened.
So you were just going, oh my God.
Oh, yeah. See, the problem is I couldn't even get back in because there wasn't anybody willing to take the other side of the buy orders. On a limit move, you can't get back in. So I sat back and watched in complete agony. I mean intense agony.
Did you throw up?
I didn't throw up, but you know, it's like maybe I almost did. I don't know. Go ahead.
Why didn't you get out? You said you had 5 contracts?
No, 2.
Two.
Just
Why
2.
don't you just take one off the table, let the other one run for another day?
First of all, Jerry, you're assuming that I knew that this was going to happen.
No, I'm assuming that getting out all at once takes you out of the play completely.
Jerry, have you ever been in a situation where you really lost a ton of money and you just can't deal with it anymore?
Yeah.
Well, that's where I
I've
was
been in
at.
a situation where I've been down a lot of money.
Okay.
I didn't lose because that's on paper.
No, well, commodities, no. With stocks, you're right. With stocks, it's technically on paper. When you're in commodities, the money's out of your account. It's gone. It's gone at the end of the day. Okay, it's not. This is not paper money. This is real money. Are you with me on this?
Yeah, I'm understanding you.
Okay. So I wasn't looking at like I said, paper losses. The money was out of my account. So I had enough. I couldn't take it anymore. So when you think about it in that context, when you just made up your mind that I just can't deal with this anymore, it doesn't even occur to you to get out in stages. Why would I get out in stages when I've already gone through a week and a half of this back and forth, and and it's virtually wiped out my account? Because by then I probably would have had to put more money, even for me to take just one contract off and leave one on, I probably would have had to put more money in the account. And there just wasn't any point in doing that. Are you with me on this?
I don't trade commodities. I trade other things,
But the concept's the same.
except it doesn't come out of my. It's, as you said, it's a paper trade.
Yeah, you already own. If you own stock, you own an asset.
I don't know.
And if you want to hold on to that asset until it goes down to zero, that's fine. Okay, your money is not flowing. In a sense, money's flowing out of your account, but not in the same way it is with a commodity.
No.
Okay, I have to pay that money right now. You're just losing the value of an asset. I actually have to pay that money. And it comes out every single day. Go ahead. Go ahead and hand the microphone back to that gentleman.
Another thing that can be of interest here is, at least from the way I gathered you was talking a while ago, you really weren't controlling this. Your broker was doing this.
Correct.
So even if you had wanted to get out in stages, your broker was doing it, saying, hey, here's what I'm doing to you. In this case.
Yeah, pretty much. Yeah, it's like I wasn't really in control of the situation because I didn't know what I was doing. All I know is that I was within, let's say, a half an hour, 45 minutes of a monster trade, a monster trade. Yeah, I got it. And like I said, I sat back and watched in agony as the market went up to $49 an ounce. I'm thinking to myself, I was like that close to $400,000 on just 2 contracts. $400,000. And so, like I said, when I first started telling you this really had a profound impact on me. It really did. And I thought to myself, and at the time, I was managing a commercial casualty insurance agency in the suburbs of Detroit. Not really, I thought that's what I wanted to do. I didn't really know what I wanted to do, but, I aspired to management. I was very successful. And, at the time, even back then in the late 70s, early 80s, was making a 6-figure income, and I was only in my early 30s. So, I really had a lot of things going for me. But, after this experience, I thought to myself, I got to figure out what's going on here. And I certainly wasn't going to be able to do it in Michigan. So I thought, you know what? I'm going to Chicago. And that's what I did. I went to Chicago. I just thought, if I'm going to get into the business, who am I going to get into the business with? Well, back then there was Merrill Lynch, there's Dean Witter, Smith Barney, and I thought, who are you going to pick? You pick Merrill Lynch, right? Okay, so I went over to the Chicago Board of Trade. They have an office right there, and right on the second floor of the Chicago Board of Trade. And they just so happened they had 3 openings for trainee brokers, and they had over 1,000 people applying for it. So how am I gonna be one of those 3 people? I thought, well, you know what? I went back home. I went to one of the bigger Merrill Lynch offices in the Detroit area, and I went through the whole employment process to familiarize myself with what it is that they required to get a job. And this is what I think got me that job at the Board of Trade. is that they had an aptitude test, and there's a multi-page application, but on the back of the application they had a square like this, you know, and they wanted spontaneously, while you're in the, you know, while you're filling this application out, spontaneously what they wanted you to do was to write like a little mini essay about some philosophical question. Before I went to the Board of Trade and actually filled out that application, I spent 2 weeks agonizing over every word, just to make sure every word of that 2 or 3 paragraphs that I wrote down was completely perfect. So that when I took the app, I wrote down exactly what I'd worked on. And I can imagine why they hired me, because if you thought that I wrote that spontaneously in the moment, thought, hey, this guy, we got to have this guy here. We got to have this guy. Okay, so I did. I got the job. Now, think about this. Now, when I was working for the agency, the casualty agency, commercial casualty insurance, as a matter of fact, I just signed a contract not more than like 3 or 4 months before I actually went to work in Chicago, over a 3-year period for $360,000. And what Merrill Lynch was offering me was $20,000 on a draw. Okay, in other words, it was a, you know, they're going to give me $20,000, but it's a draw. I mean, I got to pay it back based on commissions. Now, if you can imagine, there wasn't one person in my life, not one person, who thought that I wasn't absolutely stark raving out of my mind to give that up, to go to Chicago to do this. So, you know, it wasn't like I had a lot of support. You know, and it wasn't like I wasn't catching a lot of grief from everybody that I knew about what it was that I was doing. So you can imagine my horror, is a good word for it. I mean, because when I got to Chicago, I'm thinking, why am I even doing this? I'm doing this because I'm going to Chicago because that's where the traders are. That's where the people are who know what they're doing. Correct? And then to get there to find out that that is not the case. That is not the case at all. That there were 40, almost 50 brokers in the office, and none of them knew how to trade. And not only did they not know how to trade, I mean, Merrill Lynch made absolutely no bones about the fact that we were not traders. They spent no money, no time, and completely discouraged us from even learning how to trade. We were salesmen. We were taught how to talk about trading. We were taught how to talk about investments. We were taught how to, you know, it's called dialing for dollars, to get on the phone and get people to open up accounts. And even though this was unspoken, I'd say the underlying philosophy behind the business was, especially in the commodities business, I'm not talking about the equities. I'm not saying that on the equity side of the business that it wasn't more reputable. But this was about as irreputable as it could be. Because the underlying philosophy that we operated from was, all commodity traders are terminal, meaning like they have a terminal illness. It's only a matter of time before they want to say, all commodity traders are terminal, and it is our job as a broker to make them as comfortable as possible until they expire. In other words, to extract as much money out of their account as you could until they're gone. And even to this day, it just blows me away to think that when I went to a 30-day training class in Manhattan, and there were brokers from all over the world, probably about 80 or 90 of us, and the guy and the person that was the head of Merrill Lynch Commodities at the time, his name was John Conheeney, and when he came in to address our class, and to this day I don't know why he did this, but he, like he said, hi, and he started out with these words: the average Merrill Lynch customer loses all their money in 6 months. And that was the truth. Commodities, not equities, commodities. And that was the truth. That was about what it was. It took about 6 months for people to lose their account, and you just, like I said, you just go to the next one. So here I left this 6-figure income to go to Chicago to learn about this business and this industry, and here I'm in a situation, and it's like, it was, like I said, it was appalling, absolutely appalling. So I thought, well, okay, I'll make friends with people on the floor. They must know what they're doing. The floor traders know what they're doing. Well, I found out that wasn't necessarily the case either. Now, it doesn't mean that the floor traders didn't know how to make money. But and this is, I'm not going to get into this because we don't have time. But even though what you do is called trading, and what they do they call trading, the way and the mindset that you have to make money couldn't be further apart, even though they're both called trading. The typical local, when I mean the person who traded for their own account in the pit or on the floor of the exchange, the way they made money, almost they weren't trying to make direction related decisions. In other words, it wasn't the kind of trading where they would find themselves in winning trades that were going in their favor, but that's not the reason why they put the trade on. And like I said, I'm not going to get into the specifics or dynamics of it because it'd take me too long to explain, and it just isn't necessary for right now. All I'm saying is that it's a completely, as a matter of fact, before I left Chicago and moved to Arizona, the Chicago Mercantile Exchange asked me, and I worked on it for a while, for about 6 months before I left, asked me to put together a program to help floor traders make the transition from the floor to screen-based trading, because it's a huge psychological leap. It really is. It's a huge transition that has to be made. So what I'm saying is that, not knowing that before I got to Chicago, it was like here I'm in a situation where I really didn't know anybody who really knew how to trade, or at least knew how to trade in the sense of creating that consistency that we're looking for. It doesn't mean that people couldn't make money. People were making money all the time. It's just that, what's the point of making money if you're susceptible to giving it all back? In other words, if this is your equity curve, and then all of a sudden you're experiencing these huge losses and huge drawdowns, not only is this certainly damaging financially, but it's also damaging emotionally. And it can be very difficult to recover from. These are what I call the boom and busters. Okay, you basically had traders that fall into 3 categories as far as equity curve is concerned. You've got your consistent winners, the people who have, the traders, you've got your consistent winners. Now, it doesn't mean that there aren't drawdowns here, okay? But what do you think these drawdowns would be a reflection of for the consistent winners? Consistent winners take losing trades all the time. But their drawdowns are a reflection of what? Anybody got any ideas?
Good money management skills.
Yeah, money management skills. Capital preservation. Okay, these are 2 good answers, but not the answer I'm looking for. Their drawdowns are simply a reflection of the normal losses that any trading methodology will incur. There is such a thing as normal losses. You don't have to write this down because we're just starting to scratch the surface. We are going to go into this in far more detail later on. So, I mean, if you guys want to write it down, that's fine, but it really isn't necessary. Okay? Normal losses that any trading methodology will incur. Then you've got people who learn something about how to trade, who acquire a good methodology where it is possible, based on that methodology, to experience a consistent income, but your equity curve might look more like this. Most people who are experiencing the boom and bust cycles, these are the bust cycles, would say that something happened in the market to cause this. What you're going to find out today is that it is not the case. Even though it may seem like it, it is not the case. These are virtually always the result of trading errors, what I call trading errors, which we're going to go into in detail later on. One of the, just for the gentlemen, few people back here that don't have any idea of my background, I'm going to go a little bit further in it, and I'm just going to jump ahead for a second. I ended up being a trading coach, and working with. I was a trading coach for probably about 17 years. I don't really do it much anymore. I just pretty much focus on my own trading. But but while I was, especially in the, throughout the 80s and most of the 90s, I worked with a lot of floor traders. And we talk about boom and bust. There was one of the floor traders I worked with was probably one of the 5 biggest bond traders at the Chicago Board of Trade. And when I met him was in like around May of 1992. And from January of 92 until the time that I met him in May of 1992, he had around, this is a guy that just traded for himself. He didn't trade for a firm. He just traded his own account on the floor of the Chicago Board of Trade in the bond pit. He had $12 million roll in and out of his account. And he had a particularly bad day, and he ran into somebody who attended one of my workshops and said, hey, you should go see this guy. He called me. We had a few appointments, didn't really go anywhere. And the next thing, about a month later, I get a frantic call from his wife, who I hadn't even met, didn't even know who she was. Got a frantic call from his wife that said, they're going to lose their house if I don't do something with him, okay? he had another real bad day. So anyway, I started working with him in July of 1992. And from July of 1992 until the end of the year, he ended up the year with almost $6 million. Now, that may not seem like a lot considering he had these swings, but he'd never finished a year with more than, I think, around $650,000 or $700,000. So he had just under $6 million. And so then he went on vacation. He happened to take a book with him called The Coming Collapse of the Bond Market. And this would have been in like late December of 1992, early January of 93. And came back. Now, if anybody remembers the bond market back then, it rallied to spectacular heights. But in the meantime, he'd read this, The Coming Collapse of the Bond Market, so he was going into the market every day short, okay? And pissing away this $6 million until he got to the point where he had about 2 of it left. And took him about, I don't know, until maybe mid-February. And he was so exasperated that he said, hey, you know what? I'm willing to do anything. Okay, now keep in mind, I'm willing to do anything. And it wasn't lip service. It was real. It was genuine. It was sincere. And I said, if you're willing to do anything, then here's what you have to do. What I've been working with him, what I noticed is that he was able to stay focused really for not more than about an hour a day. Now, this guy loved trading. I mean, he just loved being in the pit. He just loved every part of it. He just had the hardest time tearing himself away. But if he really wanted to make consistent money, then I felt that an hour a day was about it. Because after an hour a day, he'd start losing, his focus would start to diminish, and then he'd also start to get reckless. He was the kind of guy, and this here again, this is very difficult for people to comprehend, but it is the absolute truth. He was the kind of guy where, when I was working with him during that period, in the second half of 1992, where he would have he'd have a $500,000 day winnings. He'd make $500,000, but when he called after he was out of the pit to have his consultation, he'd be real angry with himself, because he, up to about 5 minutes before the close, he was up $500,000, and then he'd piss away about 175 of it. So it only ended up with $325,000 for the day. Now, this is just like a normal guy like us here in this room with $325,000, and this was not an abnormal day, but he's real angry with himself because he pissed away that 175. And then the next day, he'd do about the same thing. He'd make 400 and piss away maybe 2 at the close. And then the next day, he'd make, 350 and then piss away another 150. He's got spectacular wins up until Friday. But this accumulated anger that he was building up throughout the week, Monday, Tuesday, Wednesday, Thursday, by the time Friday rolled around, he'd lose $1.5 million. And then start the cycle all over again. So now it's like I'm saying, you know what? Especially as a floor trader, As a floor trader, you really have to be focused. When you're trading at the level that he traded at, where you're trading hundreds of sometimes thousands of contracts, if anybody knows anything about the bond market, we know that one incremental price change in a bond contract is $31.25, okay? You guys with me on this? So this would be a tick. So in other words, if the bonds went one tick up and you're long one contract, you'd make $31.25. If it went down one tick and you were long one contract, you just lost $31.25. He would trade 1,000 contracts at a time. That means one incremental tick price change was $31,000. $31,250. Now, if anybody's ever watched the bonds move, you know that it can move 5, 10, 15 ticks like that. Not only that, there can be what's called price vacuums. Everybody familiar with a price vacuum? You know what I mean by price vacuum? It means that if the bonds are at let's say 106, 106.10. You guys are probably not familiar with bond prices. 106.10, that was the last posted price. That something can happen and you're long. Something can happen where there are no more offers and the next posted price is 106 even. That means the market went down 10 ticks without there being any trades between 10 and even. No trades at all. Which means if you're long, you just lost in that instant $31,000.25 on 1,000 contracts. This is quite common. So you really have to be focused. It would be like when you're trading at this level, I would make an analogy. It's almost like, there's a couple of analogies. One, it's like if you're in an NBA playoff, it's the finals, it's the last game, 7 games, it's 7-game NBA finals, 1 minute left, the score is tied. The coach is going to send somebody in who's really focused. If the coach thinks you're distracted and you're not on your game, you think you're going to get in that game? This is the way to be in these kind of circumstances in the pit. That's the kind of mindset that you had to maintain. Because even if you were distracted and turned away, there could be bids and offers that would have gotten you out of your trade that all of a sudden dry up. Meaning when guys are bidding and offering in the pit, they're using hand signals and they're telling you they want to buy or they want to sell and how many. And there's hundreds of guys all around screaming. Now these bids and offers can dry up because when you make eye contact and you point, you say, okay, we've got a trade, and then you write your trade down on your trading card, or now it's an electronic handheld device. But otherwise, you make a trade, and then you could be out of your trade and take your profits. When these kind of things happen, these price vacuums, you could be in bad shape, and just be a matter of just a momentary look away. The guy that you were going to use to get out of your trade is gone now. He put his hands down. Uh-oh, I'm in trouble. Well, what I found is that he could maintain an ideal mindset for about an hour a day. And so that's what I said. If you're really sincere, if you really want to do anything, you can only trade an hour a day. And he agreed to it. And he said, what hour a day? I said, it really won't matter. And it really didn't. He was convinced initially that what hour he went in would make a big difference. It really didn't make any difference at all. He was so good. As a matter of fact, there were other bond traders that I work with that said that watching him trade would have been the equivalent of like watching Michael Jordan play basketball. He was that good. And so he did. He went in just 1 hour a day. And because he knew that he only had that 1 hour, he was really focused, and he was averaging $175,000 for that one day, or for that on an average for that 1 hour per day. Okay, but that would be an example. He would be an example of an extreme boom and buster. Everybody kind of have that concept down in their brain about boom and busters, okay? And then what you have is the consistent losers. People whose equity curve looks like that. Now, just to get back to my situation, like I said, when I went to Chicago, I'm thinking, okay, I mean, I've got quite a bit of money. I sold my interest in the agency, but at the same time, I had a pretty expensive lifestyle, as you can quite imagine. I had a house in Michigan that I had a girlfriend, a very high maintenance girlfriend, and her two daughters were living in. And I had a very expensive apartment in Chicago and a Porsche, and I had the life, okay? And I was going back and forth every weekend to visit them. So I mean, really, my situation was, I couldn't maintain that kind of lifestyle with the money that I had without being successful as a trader. And that was the whole idea anyway. I thought, okay, I'll make whatever shortfall that I end up with as a trader. And interestingly enough, I had to have my trading account with another brokerage firm secretly. I couldn't trade through Merrill Lynch. And there wasn't anybody else in the office who traded their own money. I was the only, unless they were doing it secretly and didn't tell me. I was the only person in the office who was actually trading their own money. Who actually traded, period, other than putting on trades for their customers. So what ended up happening is that, and another part of this is that I also had this, I can't really tell you why I knew this, it's just that I did. It just made sense to me. It just never occurred to me that trading was anything other than about psychology. I mean, the first trading book I ever bought was actually the very first book on trading, the first book that was devoted specifically to trading psychology, which was Jake Bernstein's Investor's Quotient, that came out in 1980. And there weren't that many trading books even available back then. And that was the first trading book that I didn't buy a book on technical analysis, I bought a book on trading psychology. So I was not only immersed in the concepts of trading psychology virtually right from the very beginning, I was also keeping very extensive journals of my thinking process, what was going on, what I was observing from other brokers in the Merrill Lynch office, as well as what I was observing from interacting with my customers. And I noticed we were all kind of conforming to the same patterns, the same problems. But just say that because I did have this kind of foundation, to understand that it was basically psychological in nature. Because one of the things we're going to talk about, when I get into the skills section of the presentation, is that when you look at trading skills, it's like, well, what kind of skills are we talking about? If we're talking about thinking like a professional, we're implying that the skills are all mental in nature, and they are. Because when you really get right down to it and you really start to think about it, what physical skills are necessary to trade? We're not talking about a golf swing or a tennis racket or any other kind of physical endeavor that we're familiar with. What kind of skills what does it take physically to put on a trade?
A mouse click.
A mouse click, that's it. Your ability to move the mouse and click it on the buy or sell button. It's that simple. And as a result of it being that simple, it's easy to think that, oh my God, trading is so easy. It isn't. As you well probably know, whether you've been at it a long time or even a little bit of time. There are some very sophisticated psychological skills that you have to acquire to get this kind of an equity curve. And virtually all these skills are founded in learning how to trade without fear. That's basically what this whole workshop's about, is learning how to trade without fear. Because that's what's going to screw you up on virtually everything. Everything that you can do wrong as a trader is going to be the result of what you're afraid of. And the effects that fear has on your perception of market information. So so with my situation, it's like here I'd given all this up to go to Chicago to learn how to trade, to find out that the only people who really knew how to trade back then were people that I didn't have access to. Meaning there were some big names in the industry who never really took the time or expended the effort to find out exactly what it is that allowed them to create a consistently rising equity curve. What they would say is, well, yeah, you got to go with the flow. The trend is your friend. Cut your losses, let your profits run. There's all these neat little phrases, but it's like, who in the hell knew what that meant and how to do it? Yeah, it sounds great. Cut your losses, let your profits run. Oh, even cutting your losses can be extremely difficult to learn. Letting your profits run can be 10 times more difficult than learning how to cut your losses. In fact, it's one of the most difficult things to acquire in terms of a skill is learning how to let your profits run. So it was like all this was kind of building up, and my lifestyle was draining my money away. And one of the things that I would say characterized me back then, if I was probably obsessive about anything, it was my credit. It's like my credit was as far as I was concerned, it was like the most important thing in life is to have flawless credit, not just, flawless. And here I'm in a situation where I am truly running out of money. And my trading losses, it wasn't really like I was losing a lot of money trading because I'd really stopped the hemorrhaging. I wasn't trading in a way where I was actually losing money, but I wasn't making any money. And it's like there was always this little voice in the back of my brain, it would come to the forefront of my consciousness that would say, Mark, this ain't adding up. There's something wrong here. There's something wrong. It's like it's not adding up. And then I kind of shove it back there and, it's going to be all right. I'll figure it out. It's going to be all right. Eventually it got to the point where I was literally out of money. And the only choice I had was to file bankruptcy. Fortunately, I was in a situation where I had 2 residences, one in Chicago and one in Michigan. And so I had a choice of where I filed. And of course, I filed in Michigan because if Merrill Lynch would have found out, they probably would have fired me. As a matter of fact, nobody knew what had happened. Nobody that I knew in Chicago knew what had happened. So I filed in Michigan, and I'm thinking, literally, because of my attitudes about credit, I'm thinking, if I've got to do this, I'm going to fall beneath the cracks of society and never reemerge. I really believe that. I honestly, God, really did. I just didn't see how it's possible to live after having to do something like that. And of course, what I found is that, and when I ended up, what I say in the Disciplined Trader, and I don't really go into a lot of detail in the Disciplined Trader about this, but just to say that what I ended up with was really, I had an apartment, I had my bed and my TV, and when I filed, I was still current on everything. I wasn't even late one day on any of my bills. As a matter of fact, I even called the finance company to come and pick the car up. But I wasn't even late a payment. I said, you know what, I can't do it anymore. You're probably going to want it back anyway. So, it was like, come and pick it up. And of course they did. And guys, there's a funny story about that. I never told anybody this, but you guys want to hear a funny story about that? When the guy came to pick it up. And so I'm thinking, because we were in front of the apartment building, and I'm thinking, well, if he's going to pick this up, then I ought to get some sort of receipt that it was in perfect condition. Because I don't know what the hell he's going to do to it on I don't know. So it's like, and the guy wouldn't give me a receipt saying that. And so I wouldn't give him the keys. And so, so he called his boss, and I heard his boss on the other end of the line screaming at him, "You do whatever he wants to get those keys," just like, and he said something else I'm not going to say for this particular presentation, but yeah, it was like, they just someone's willing to give you the car, but they don't even have to go repossess it. It's like, hey, give them the receipt. But in any case, what I realized, I mean, now you think about this, it's like when you define yourself based on your possessions. Just like anybody that loses anything, you've got an internal representation and you've got an external representation. And now there was a discrepancy between what was outside of me and what was inside of me in terms of the way that I define myself. And so that has to be reconciled. And what I realized, and it didn't even really take that long. I don't remember how long it took, but it was like, one, I still had my job at Merrill Lynch, and so as a result, I mean, it's like I'm starting thinking, okay, well, things are going to be all right. I was in my worst fear. I mean, that was my worst fear. I mean, when the fear would creep up into the forefront of my mind, I was like, that was my worst fear. Now I'm in it, and I'm realizing that, I think I'm going to be all right. I'm healthy. I can still think. I'm going to be all right. And when I came to this realization that I'm going to be all right, this is when things change for me as a trader. And this is the interesting part about my situation that most people don't have the benefit of experiencing. There are two things. One, I had this foundation of knowing that it was all psychological anyway. So I had all these things that I'd been working on up to that point. And two, when you tap out as a trader, I mean, when you really tap out, you don't get to trade anymore because you don't have any money, right? But I was in a situation where I still got to trade. Even though I was working with other people's money, I still got to trade every day. And so as a result of experiencing my worst fears, coming to the realization that I'm going to be all right, and then at the same time being in a position where I'm able to interact with the market, it was like, because I didn't have anything more to lose, I didn't. It was like this, the market completely changed for me. It was like I had these blinders on that all of a sudden just came off because the market was different, because I wasn't afraid anymore. I was seeing the same patterns over and over and over again beforehand, but I was seeing the same patterns differently. I was seeing the same patterns from a, let's say, relatively carefree state of mind. And that relatively carefree state of mind allowed me to, like say, flow in and out of my trades with an ease and effortlessness that I would not have been able to imagine beforehand. And then what happened is that I started making consistent money for my customers. And there's even, there's one really, as a matter of one really good story where, I mean, there are a lot of good stories that I can tell you about my customers at Merrill Lynch. But in one case, I inherited this guy who at the time was the head of the state of Illinois' mainframe computers, and he was from India. And he had put together his own trading program, and he was using the state computers to do it. And so, and he had an account, technically an account with Merrill Lynch, but wasn't funded because he'd lost all his money. But he still maintained the account. And so I inherited him as a customer, and he would call me every day, and he was just like, and all he would say to me is like, I'd pick up the phone. He wouldn't say, hi, how are you? He'd say, give me data. Like give me the high, low, and close. And, so we interacted like this for a long time. Well, he came up with his own day trading system that eventually, well, because he and I started working on it together, he had the internal program for it, but he didn't have any money management parameters for it. So after about 2 or 3 months of working with him on it, we came up with some really good money management parameters. And then all my customers started trading it, and we were making consistent money day after day. Even to the point where Merrill Lynch was starting to take notice. Here all this whole customer, his customer base is making money, and he got to the point where he's thinking, okay, all these people are now deriving this benefit from my work. I should be able to do it too. And he talked his wife into letting him put $5,000 into his account to fund his account. Now, I didn't know what happened to him. Why? I mean, not like we had personal discussions, so I don't know why he didn't have any money in his account. The guy was a maniac. It's like he put the money in his account, and 2 days later it was all gone. It was like he'd call me up and say, okay, do this. I said, well, wait a second. The system says to do this. He said, no. I don't care what the system says. This is what's going to happen. He didn't follow any of his own rules. Now here we had a track record. We had a legitimate track record, bona fide, real money, day after day. He gets a few bucks in his account, and it's like he thinks he knows where the market's going. Like I said, he was gone in 2 days, and that was it. It was all over with, because at that point, he was done. I didn't get the system because it was in his computer, mainframe computer at the state of Illinois, and had no more contact with him. And shortly after that, ended up getting fired from Merrill Lynch anyway, because there was like one of these management consultants that came in from New York, and she was going around the office talking to all the different brokers because of whatever it was that they were trying to find out. And she got to me, and by that time I was already writing The Disciplined Trader. And I just I started very exciting to say, oh yeah, this is what I found out, and this is what I've learned. And her eyes lit up saying, this is exactly what we're looking for. And she was we talked for probably about an hour and a half, and she was all excited. And then she said, I got to go tell, well, I'm not going to say his name, the office manager, okay? And she walked away from me, walked over to the office manager. 10 minutes later, he came over and said, pack up your stuff and get out. Right then and there on the spot. Pack up your stuff and get out. So that's how I ended up actually being a trading coach, because by then, floor trade, because I'd made friends with floor traders. I was making friends to find out how they trade and that sort of thing. Well, they started coming to me for advice, even while I was at Merrill Lynch. And because it's a pretty small community, the word gets around, especially when people are really genuinely helped with the kind of advice that you're giving them. And I'd help several floor traders turn their trading around. And so what had happened is I started getting hired by clearing firms. What I mean by clearing firms is that to trade on the floor of an exchange, you have to clear your trades through a financial institution. And so, it's like these are traders just like you. They have their own account, but what they have to do is they have to clear their trades through, like I said, one of the major clearing firms at the exchange. Well, what would happen is this, that it isn't like this now, but back in the early 80s, or the mid-'80s, clearing firms were in some ways like almost like family operations, where the people who owned the clearing firms, they knew all the floor traders, they were friends with them, they partied together, Christmases and holidays and that sort of thing. And so if one of the floor traders would go debit, you know what I mean by go debit? In other words, you have to have a positive balance in your account. Well, the problem with floor trading is that not today, but back then, when you traded on the floor, you had to record your trades on a trading card. So in other words, if you and I are entering into a trade where I'm going long and you're going short, what I would do is that we would take our badge, like the acronym of our badge, and our clearinghouse number, record it on this card, and how many contracts we traded. Let's say you're short 10 and I'm long 10, and the price that we traded them at. Well, those cards didn't have to be turned in until the end of the day. And then they'd all get reconciled, meaning that between all the different trades and all the traders from all the different clearing firms, this would all go into a central clearing operation to find out which trades were, to find out who's long and who's short, how much money's coming out of whose account, and whether or not they were called what are called out trades, meaning that you thought I said 10, and I thought we were doing it for 100. Okay, so now we've got a discrepancy of 90 trades. These were called out trades that had to be reconciled before the open of the next day, which is a whole nother world. We're not going to get into it. But all I'm saying is that it would not be unusual for guys to overtrade during the day, and the clearing firm wouldn't even find out about it until the end of the day. For an example, one of the guys I worked with at Merrill Lynch, eventually he was a mathematics professor. He's a really nice guy. Should not have been a trader at all. Had absolutely, Anyway, with P's at the Chicago Mercantile Exchange, and he was a one-lot trader, meaning, just traded one contract, one in and out, one contract, and eventually the forces inside of him were building up where he's frustrated with the fact that he can't make a living at it, he's just eking it out, where one day he snapped, and this one-lot trader almost took down the clearing firm. In other words, he's got like several thousand S&Ps on, several thousand contracts where other guys are into those trades and the market's going against them. So he almost took down a clearing firm just by himself. So what would happen is that because guys would go debit, meaning they end up at the day lost, maybe they're down $25,000 or $50,000 or $100,000. The guy that owns the clearing firm doesn't want to say, hey, you can't trade until you pay this off. They'd want to let him to go back into the pit to work it down. Well, after, you got 4 or 5 of these troublesome or 15 of these troublesome traders that are constantly running debits, you start to get a little worried. And so what they did is they hired me to work with these guys. Most of the information, most of the insight, let's say, that you'll find in the disciplined trader and trading in the zone came from me working with these floor traders on a daily basis. And I'm laughing because obviously it was quite a trip working with these guys, because they are not like you and me. That's really about the best way I can describe it without going into a lot of detail. They're not like you and me. So anyway, this is kind of maybe a long drawn out introduction to the fact that what we're talking about here is that you guys have a really wonderful trading methodology where there is an enormous amount of potential for you to be able to make a consistent income from being able to take full advantage of the potential that this trading methodology offers you. But I would say that there's probably, it wouldn't be unfair for me to say that there's probably what I'm going to call the profit gap. The gap between the potential and your bottom line results. This is the potential, and this is your bottom line results. Most people think that when they realize that this gap exists, that somehow learning more about the markets is what's going to fill it. And what you're here today to learn is that is categorically not the case. You have to learn more about yourself and how you interact with your trading platform and the market to be able to fill this gap. There are psychological skills involved. And when I talk about psychological skills, do anybody think of an example of a psychological skill? This is difficult. I don't think, I'm not saying that you should have the answer, but can you think of an analogy in maybe in other parts of the way we express ourselves that you can think of? What would be an example of a psychological skill?
Anger management.
Anger management? Okay, good. Anybody else? Okay. What about a situation, and anybody watch Wimbledon here lately? Just it was on? I'm not a big tennis fan, but I just happened to be watching it. And because I knew that I was doing this workshop here, this is something that really sticks in my mind. What's the difference between let's say, here, this is even a better example. What's the difference between a pro basketball player who can stand at the free throw line and hit 20 in a row, even 30 in a row, where the thing about the variables are fixed. The line and the basket and the distances, they're all fixed. And they've got the motor skills to be able to hit, like I said, 10, 15, 20 in a row, but they get into a situation where there's 1 second left and the score is tied and this basket is going to win the game, and he chokes. That's a cycle. The guy that doesn't choke has a psychological skill that the other one doesn't. Trading without fear is a psychological skill. It is a skill that the professionals have acquired, and they have evolved beyond the typical mindset, or the kind of mindset that the typical trader operates out of. So when we're talking about trading or thinking like a pro, that's exactly what I'm saying. I'm saying that you will evolve beyond the typical mindset so that you can take full advantage Full advantage. This represents, if this line represents potential, that you can take the potential of your methodology, so that you can take full advantage of your methodology. Because it has to do with your state of mind.